Thank you for viewing this Ullico webcast, Fixed Income Opportunities for Active Management. I am Joe Linehan, president of Ullico Investment Advisors, and today I am happy to be joined by Andy Stone, senior fixed income portfolio manager for UIA Investment Management. Andy, let's jump right in. There are a number of recent developments that have implications for the U.S. economy, including a change in the U.S. administration and exciting announcements regarding the success of multiple COVID-19 vaccine trials. Equity markets have responded positively to this news, but the fixed income market response is less clear. As a bond investor, how do you view these developments?
Well, at UIA, there's four major themes that we're looking at that we think are going to affect the level of interest rates and performance across fixed income sectors into the next year. The first is the monetary stimulus from the Federal Reserve in the form of the asset purchase program. The second is fiscal stimulus. Now, with the election behind us, we think there's going to be a deal in Congress, maybe not as big as the market would like to see, but we're looking for things like the Paycheck Protection Plan, the $600 a week in supplementary unemployment insurance, and maybe another $1,200 stimulus check. The third thing we're following is the COVID pandemic itself and the infection rate and hospitalization rate. We've had a little spike recently, and heard there's maybe some lockdowns coming in, but there's also been some great news from vaccines, which we think should lead to economic recovery in the next year. And the final thing is the divided government, like you mentioned. Our base case is that new administration will see a divided government, which generally means gridlock, and gridlock is generally good for fixed income investors. The first thing I mentioned, back to the monetary stimulus from the Federal Reserve, back in March, the Fed stepped in with this extraordinary liquidity program where they boosted their balance sheet and provided a backstop and a huge psychological impact to the markets that started the recovery. Every month they're going in and they're buying billions in securities, U.S. Treasury securities, corporate bonds, and agency mortgage-backed securities. At the end of last month, the balance sheet was up to $6.5 trillion. And even if some of these programs are discontinued, or it's still a huge backstop for the market. So these four things put together are all positive for economic growth. And we think this is going to result in a stronger economy next year, strengthened corporate earnings, which should support higher equity valuations and improved credit performance.
Okay, let me make sure I understand. I think what you're saying is that you expect economic growth to continue throughout next year.
Yes, that's correct. Economic growth should be strong, but it's going to be uneven across different sectors of the economy, and that should provide opportunity for an active investor like us. We've seen GDP growth estimates for next year anywhere between 1.3% to as high as 7.4%. And we think it's going to be on the higher end of this range, which we believe will result in stronger than consensus economic growth, slightly higher inflation, and slightly higher interest rates as the economy kicks into gear.
Okay, well, given that backdrop, how are you positioning the portfolios?
Well, given our outlook for higher rates, moderate inflation, and stronger economic growth, here's the way we're looking at it. We don't take huge bets on the direction of interest rates. We prefer to add value through sector rotation and security selection. But given that, we have a slight tactical short in the level of interest rates. So we're positioning the portfolios to outperform with higher rates and a steeper yield curve. Across the sectors, we have greater than market rate exposure to corporate bonds and to securitized bonds. In securitized, we like asset backs and commercial mortgages, where we have a slight overweight. We like the AAA tranches, and we tend to avoid some of the triple Bs that might have some credit risk or some exposure to certain sectors of the commercial real estate market. In agency mortgage-backed securities, we had an overweight earlier in the year, and in March, when the Fed stepped in, this sector really recovered quickly, and so we've been taking off some exposure there. In corporates, now corporates have shown extreme volatility this year, and that has given us an opportunity to outperform the index. We came into the year slightly underweight corporates and kind of an up in quality focus on the portfolio. So when the pandemic hit and the market sold off, this was a great position to be in. And when the Fed stepped in and the markets really turned around on a dime, this gave us the opportunity to buy some, high grade corporate bonds at some historically cheap levels, all the while, kind of avoiding some of the sectors that, had exposure to the lockdowns, travel, leisure, restaurants, et cetera. And, so now with the announcement of some of these vaccines, we can sell some of our outperformers like we've seen in the tech sector and rotate in some of the sectors that have underperformed, like commercial aviation and consumers and communications, things that are leveraged to a recovery. So kind of across the sectors where we're looking at, like I said, anything that's kind of leveraged into a recovery and maybe slightly higher inflation. So like in energy, we like some energy names as we see demand recovering worldwide. In the consumer names, consumer demand is recovering to pre-pandemic levels. Autos, seasonally adjusted auto sales are back to their pre-COVID levels. Metals, mining, chemicals, increasing commodity prices are good for that sector. In financials, higher interest rates and a stable regulatory environment, that's good for names that we're looking at in the banking and the insurance sector. So all in, we're looking at names that are exposed to an economic recovery.
Okay, all right. But your preference now is for corporate bonds, especially in the consumer goods and metals and minings and those sectors that would respond to economic recovery. But you've taken some money off the table in terms of reducing your exposure to technology. I have just a general question for you, Andy. I know you guys don't make interest rate bets when you're, building your portfolios, but what do you say to investors who wonder whether or not to even participate in the bond market right now, just given these extraordinarily low interest rates? What do you say to those investors?
Well, yeah, real quick, yeah, our largest overweights are in energy and communications. But, more importantly, to your second question, our message to investors that, an allocation to high quality fixed income is always an important part of any asset allocation because, fixed income is going to offer you steady returns, in the event that we see a sell-off in risky assets.
Well, good. Andy, I want to thank you for joining us today and sharing your thoughts on the current fixed income markets. I also want to thank all of you who have tuned in for the Friday Fix. For more information, please visit us at ullico.com. Thanks again.